guest of the morning is a veteran portfolio manager who emphasizes dividend-paying stocks in the equity component of his client portfolios. As 2025 gets underway, he sees opportunity in the energy sector, the infrastructure sector, and the renewable sector. He also believes Canadian telcos are oversold. Let's welcome Ryan Bushell to the program. He's president and portfolio manager at New Haven Asset Management. Ryan, thanks for coming in. Happy New Year.
Thanks for having me, Paul. You as well.
Let's begin with the telcos. Your colleague actually was here yesterday on Market Call, Rebecca Telcher. We spoke about her perspective on the telcos. Yours is likely aligned with hers, of course. Both of you see the telcos, which had a terrible year in 2024, as being oversold and offering some value here.
Yeah, and again, this isn't a 6-month call or a 1-year call. This is just something where you're be able to buy good long-term assets at what we think is a very good price. You know, if looking at BCE specifically, and they've had the most struggles, and I really have kind of the most questions about their strategic direction going forward, but it doesn't change the underlying assets of the company. And so, you know, looking back, I was explaining this to someone yesterday, or comparing and contrasting. If you look at Enbridge in 2017, 2018, you know, a lot of concerns they were going to cut the dividend payout ratio was over 100%, but at that time they were building the Line 3 replacement project, which once it came on would produce cash flows for 50 to 100 years. And now you don't hear those same concerns out of Enbridge, and stock's gone from 37 to 60.
Similarly, and Enbridge never did cut the dividend.
Didn't even stop raising it, actually raised it every year through that whole period. Now with BC, it's a little different because they don't have the contracted cash flows that Enbridge would have had to build that replacement project. But at the same time, I got to figure with the amount of data just going exponential for, you know, if your phone is going to have AI and there's going to be all these different capabilities that are built into all these devices we're all using, the demand for data and the demand to transport data is going to be huge. And that's why TELUS and Bell have been building these fiber optic networks to people's homes. So, you know, I think over the next 50 years, you're going to see that demand structurally increase, and so the pipelines, meaning the fiber optic pipelines, are going to be busy, and then the people that own them should be in good stead. So we think, you know, again, even if BCE were to cut its dividend, that wouldn't concern us on a long-term basis. The underlying assets will carry the day.
And BCE is the parent of this television channel through its Bell Media division. What is your view of the acquisition in the United States by BCE?
So I think the reason investors didn't like it was because this fiber optic build, which again, investors are increasingly impatient, right? So this build has taken, you know, 5, 6, 7 years. It's cost a lot of money. The cash flows that are going to come to it are not going to come in right away. They're going to be steadily increasing over the course. But this is, again, they're building a 50, 100, maybe even longer term asset. There's nothing currently better than fiber optic cable in terms of transmitting data. So you have to take a long view. And so the question is, you know, how long does it take them to recoup that cash flow? And then they go right into another fiber optic build in a different jurisdiction. And so I think that's why investors are frustrated, because they were kind of looking towards the end of that build. And now we've got another one coming. But from BCE's point of view, they're looking at how much more can we do in Canada over the long term. We need a longer term way to build the company. And then for us, you know, looking at our clients going, okay, we want to own this for 20, 30, 40 years. You know, we have to take a long-term view alongside the company.
Okay, let's move on to other sectors. You continue to like the pipeline sector.
Yeah, so great year in 2024, obviously, so not as screamingly inexpensive as it was then. Interestingly, you know, if you go back to the end of 2023, we had long-term 10-year rates in the US rising up towards 5%, and that caused a big sell-off in utility and pipeline stocks. That did not happen at the end of 2024, even though, again, 10-year rates climbed from about 3.5% to 4.6%. So the rate environment concerns me a little bit for the pipes, but the underlying fundamentals, which is what's carrying the day now on natural gas demand, oil being very steadily, you know, the transmission of oil being very steady, you know, the stocks are looking quite good. And Pembina Pipe in particular, which sold off towards the end of the year, that one I think is of the three, Enbridge, TransCanada, and Pembina, that's the one we're buying into more aggressively right now.
Okay, and what about the energy producers themselves?
Same thing. So they, again, were very cheap in December and now have started to rally back. ARC Resources particularly, which we own, has had a very strong month with gas prices moving up on colder weather forecasts. We're not trading the weather, obviously, but every little bit helps. And you're looking at, I think, good levels. And as you said earlier, the crude price is hanging in there. Divide that crude price by a 70-cent Canadian dollar, you're getting a $100 Canadian price for crude oil. This is as good as it's ever been for Canadian producers.
Right. Elaborate on that point, because I think a lot of investors look at a crude oil price bouncing along sideways and say, what's wrong with crude oil? And you've made this point in the past that you've got to think about it in Canadian dollars.
That's right. And so again, if you look at the concerns on tariffs and everything that's out there in the about the Canadian economy right now, the last time crude oil was, when it went to 100 or was in the 70s, the Canadian dollar was 80, 90 and over parity. We're sitting at, 10-year lows on the currency right now with oil prices that are pretty decent. So when you do, it basically just makes our production more competitive in terms of the profit margin that Canadian producers are earning in Canadian dollars. And therefore the share prices should reflect that. But our share prices are depressed relative to US producers because, well, two things. The M&A environment has not been positive in Canada for some time now, with all the problems with TMX, and then before that on acquisitions that were blocked by the Canadian government. And just a lack of enthusiasm for the space in general since sort of 2014 all the way through. So again, on a long-term basis, to pick up a Canadian Natural Resources with a nearly 5 yield right now has increased its dividend 25 straight years and has gone to a lower allocation of free cash flow, but still the same gross amount because they didn't issue any debt to buy those Chevron assets, and then going to 100% of an even bigger company going forward. You're looking at dividend growth as far as the eye can see.
Okay, why don't we finish with renewables?
Yeah, so again, an area where a lot of enthusiasm towards renewables into 2021 has really come off hard. And again, we think that the enthusiasm in 20 and 21 was probably overblown, but the negative sentiment now is also overblown. Companies with good projects like Brookfield Renewable and Northland Power, like Brookfield Renewable signed that deal with Microsoft. Everybody just forgot about it. It's 10 gigawatts. This is a major, it's going to take time for them to build it all out, but this is a major deal for them and we'll get done. This is not being driven by a government that can't finance its own debt. This is driven by a company that's one of the most valuable in the world and intends to continue to build out renewable power as part of their net zero commitment. So we think that those companies are, selectively, they're looking very attractive. And again, in the meantime, you're picking up a 5 or 6% dividend yield while you wait for things to come to fruition.
You're a believer in the AI data center energy story, are you?
Yeah. As I said to a client the other day, we get criticized sometimes for not owning technology, and that's more a function of who our clients are and what they need from their investments. They need consistent, steady returns. I can't take the risk that the NASDAQ or the Magnificent Seven, which is now 33% of the S&P 500, even though those companies are great and will stick around, could drop 50% just based on PEs getting overheated and the groupthink that's gone into flow of funds towards U.S. equities in general. But what I can do is purchase companies that will live off the power demand that's being created by AI for decades, and that's much easier to predict because the infrastructure is already in place and just needs to be added on to. So the companies that are in those positions where they have that infrastructure, you can basically bet that the data centers are going to have to cluster around that existing infrastructure. Right. And so, again, I think it's the safer way to go, and we're less at risk of this kind of flow of funds. People don't want to own $34 trillion in U.S. Treasuries, so they're putting money into equities thinking that that's the only place to preserve capital. But again, too many people on one side of the boat sometimes tips over. So, we're just trying to take the safe road for our clients because they can't afford to lose any of their capital.
Ryan, thanks a great deal.
Thanks, Paul.